Well, we saw a very classic run on the bank. SVB had had a few problems. It wasn't a great bank going into this circumstance. But what we saw was after the announcement a couple of days ago, basically the venture capital community creating a run on the bank by announcing that everyone should be pulling their money out, and those who could did. And almost immediately, the FDIC recognized that that didn't make the bank a sustainable enterprise and stepped right in to stop things, mostly in order to ensure that depositors were protected as much as possible. So it was a good thing that the FDIC stepped in to protect the depositors, even though, of course, the equity holders took significant losses.
So what really it comes down to, this is a symptom of rising rates. And it's a lagging symptom of rising rates. I mean, these hikes happened last year that caused the bond portfolio of Silicon Valley Bank to be worth less. And now the economic difficulties now, one might argue, are causing their deposit levels to go down. So they had to go and sell those bonds. And now people, right, are freaking out for a somewhat understandable reason. If you didn't get your money out of Silicon Valley Bank yesterday or the day before, today you wish you had. So what is the broader market implication here? Because, yes, Silicon Valley Bank is an important story, but where else are we potentially seeing rising rate impacts that, you know, the frog's been boiled up to this point, but it's about to die?
Well, I think the big question is whether the Fed steps in and the FDIC steps in to stop any risks to the broader, smaller bank ecosystem. Because right now, basically, you know, SVB is a top 20 banking institution in the country. And I think one of the questions is, do you want to hold your deposits at a bank that isn't one of the big money center banks? If the Fed isn't going to protect the depositors in the SVB situation, then it calls into question whether you should be holding your deposits anywhere in the smaller banking system as opposed to the big banks. And that could create a cascading effect that really has not much to do with the core banking infrastructure of the U.S. economy or even the activities that those banks are doing. It's a classic bank run. The question is, are they going to actually do what's necessary to help halt that? Because right now, when we look at what's going on in the markets, we're seeing significant repricing of those smaller banks that might be affected by the secondary effects of this situation.
Yeah.